Hello everybody, this is Professor Hasty again. This is our week one midweek video where I talk about key topics at hand for this week. Again, I'm speaking, it's Thursday morning, January 9th, and I'm again speaking live from Claremont, California. Today's topic is just basically our review topics of this week. What is finance? Managing financial resources is our class. Well, what does that mean? It means the management of capital financing. Capital. Corporate finance is important to management because the knowledge of capital budgeting, capital structure, and working capital provides for effective decision making if the corporation is to maximize profits and stay competitive for future success. Translation: the management of your cash is key. The goal of every company, both not-for-profit and for-profit, is to maximize value for their shareholders, their investors, their customers, their employees, their ownership. How do you maximize value? Well, you have your stock price go up. You create services and quality for your customers. You provide a return on the investment to your bankers by paying your loans. And above all else, you provide value and wealth growth. To achieve this, you have to manage your capital. You have to invest in assets that provide adequate returns and efficient models. Corporate finance is the management of this. This class at the MBA level in advanced finance is to develop strategies that can most efficiently manage this maximization of value. That's what we'll attempt to do in this class. There are three key principles to finance. The investment principle, which is to invest in an asset, a resource that provides effective return over time, not so much return as high profits, but return over the cost of the money that it took you to make that investment. It's called the hurdle rate. It's called the weighted average cost of capital. It's called opportunity cost. Various ways of explaining it, but it's the cost of money. Are we investing in resources that provide an adequate return over that cost? That leads us into the second principle. How do we finance those assets? It's the mix of debt and equity that produces the lowest cost of capital. One of the main reasons why we've been on about a 10-year growth rate in this economy is because money has remained cheap. Either arbitrarily or by the supply and demand of the markets, money continues to have low interest rates, low inflation. The cheaper the money, the greater the value, the greater return, and companies can create growth and hire more people, go into new markets. That's what's happening right now. There are three legal ways to obtain capital. Debt, either short-term or long-term interest-bearing debt. Equity, be it public or private equity. Private equity for smaller firms like private investment, Shark Tank money, angel investment, private funding. And then there's the public equity, the owning of stock by the public in corporations. That's the second form of financing. And the third form of acquiring capital is old reliable profits, the making of revenue over expenses. Reinvesting profits back into the company to fund future growth. Debt, equity, profits. That mix of those three vehicles is what makes companies perform at their optimal levels. And then finally, the third principle is how do we distribute these returns back to our investors? In the form of dividends, in the form of buying back stock dividends, payments of debt, interest expenses, How do we distribute that money back, or do we just hang on to it? A key financial principle. The main source of this value, of this wealth, is called free cash flow, something that many of you probably haven't seen before. Free cash flow in the form of money available after you've managed the operations of your company, paid the bills, collect the receivables, pay the debt, pay the short-term working capital. What you have left over to pay interest on long-term debt, principal, dividends, buying back stock and invest in new assets, new companies, new growth. We're going to talk about free cash flow many times throughout this class. All in the environment of weighted average cost of capital. That cost of capital of equity and debt that determines the value of our business. A very important concept of finance. In relationship to the world around us, key financial indicators that tell us in finance how we're doing in relationship to other countries, our competitors, other markets. According to Professor Hasse, this is his key 9 financial indicators of our economy. This is the status of the equity markets, the debt markets, the commodity markets, and the currency markets a year ago, December 31st, 2018. The Dow, the S&P 500, the NASDAQ. You should all be familiar with those indexes and what they represent. The 10-year United States Treasury yield, basically also known as the risk-free interest rate. The 2 leading commodities in the world, oil and gold. Oil as a leading commodity of funding business, economies, countries, and gold as a hedge to risk in the market. And the relationship of the United States dollar to the euro, to the Chinese yuan, and the Japanese yen. The dollar historically over the last few years has been very strong. It's been diminished a little bit lately with the tariff situation and the Brexit situation, but it's still the strongest currency by far in the world. Here's what those indicators look like today. Notice the equity markets, 20 to 25% increase in the last year. The United States risk-free interest rates has gone down. Money has even gotten cheaper. Buying a house today is cheaper than it was a year ago as far as interest. Getting a car loan was cheaper now than it was a year ago, especially if you have good credit. Crude oil, gold have gone up. And the relationship of the United States dollar to the major currencies of the world is pretty much about the same, maybe weakened just a tad. But it's important for us to manage financial resources and know what's happening in the world around us and how the world is changing and how it influences our own particular markets and competition. So as I conclude this first week of our class, I want you to continue to review the basic fundamentals of our class, the syllabus, the blackboard. If you have not already done so, please submit your bio and please submit an appointment with me. I opened up another set of times on Saturday of this week. About 8 students still remain who have yet to contact me. Remember, this is graded work for this week. For those who've already seen me, I've already posted a grade to Blackboard as your initial grade in this course. So if you have not done so, please schedule an appointment. If you do not by Saturday, you will get a 0 for that effort. And that's not a good way to start the class. So please check your email and please make an appointment with me for this week. And then next week, we'll talk about in more detail the concept of stocks and bonds and capital in relationship to how it finances our business. So thanks everybody. I hope you have a good weekend. If you have not already done so, make sure you submit your work for this week, and I'll see you back all on Monday of next week. Thanks everybody. We'll see you then. Bye-bye.